Thank you for joining me. I'm Juan, lead trader and founder of ProsperiTrade. In today's video, we're going to discuss the Greeks. We're going to give you a basic introduction to the Greeks in regards to options. This is not an introduction to options class. You should have a basic understanding of calls and puts, buying them and selling them, and some basic terminology. Here, we're just going to look at a few Greeks and try to get a basic understanding on how they work with regards to options. Our first Greek is delta. Delta is the Superman. Delta's domain is price. Delta is positive for calls and negative for puts. Call options for delta are 0.0 to 1.0. Put options are 0.0 to negative 1.0. If a stock option has a delta value of 0.65, this means as the stock price increases by $1, the option price will increase by 0.65 cents per share. Let's look at stock XYZ trading at $13. If a long option has a 0.40 delta, if that XYZ stock trades at 14, then the option will increase by 40 cents. So here we have stock XYZ trading at $13, option price is $2, delta 0.40. So the option costs $200 because you multiply $2 times 100. Tomorrow, XYZ is now trading at $14, so that delta increased that option price to $2.40, giving you a $240 value with a $40 profit. An options delta is often used as a proxy for the estimated probability that a given option will finish within the money. For example, an option with 0.40 delta has a 40% chance of finishing within the money. Delta tends to increase as you get closer to expiration for near or at the money. Delta is not a constant. A concept related to gamma, which is a measure of the rate of change of delta given a move by the underlying stock, of course. So gamma is delta's sister in a way. Gamma measures delta's rate of change over time. Like delta, the gamma value will also range between 0 and 1. Gamma is the rate that delta will change based on the dollar change in the stock price. So if delta is the speed, then gamma is the acceleration. So here we look at this chart. We have a stock trading at $48, delta at 32 cents. So when that stock hits 49, it'll be a 32-cent increase. Gamma is 0.08. So the next day, now the delta is 40. And the next day, gamma is 0.10, the delta is 50. And as you get closer to expiration, you see that the gamma spikes up from 0.09 on the bottom to 0.40. Time decay, or theta, is an enemy number, 1 for the option buyer. As a rule of thumb, the closer an option gets to its expiration date, the more it will drop in value. A theta of 0.28 means the call option will decrease about 28 cents in value every day. So it's important to look at the theta. Here's a chart. We have 150 days to expiration. Theta is 0.018. Option premium right now is $5.30, which is $530. Over 30 days, it dropped every day 0.018, bringing it down to $4.76. We can see how much the value drops till the last day. That premium is 0.21 cents, all the way down from $5.30. Vega measures the sensitivity of the price of an option to changes in volatility. So before we go on to Vega, let's take a quick look on what is volatility and implied volatility in options. Implied volatility is the market's forecast of a likely movement in a security's price. Implied volatility is often used to price option contracts. High implied volatility results in options with higher premiums and vice versa. Supply and demand and time value are major determining factors for calculating implied volatility. Implied volatility usually increases in bearish markets and decreases when the market is bullish. For example, imagine stock XYZ is trading at $50 and the implied volatility of an option contract is 20%. This implies there's a consensus in the marketplace that a one standard deviation move over the next 12 months will be plus or minus $10, since that's 20% of $50. In theory, there's a 68% probability that the stock trading at $50 with an implied volatility of 20% will cost between $40 and $60 a year later. There's also a 16% chance it will be above $60 and a 16% chance that it will be below $40. And here on the right, we have a little chart that gives you an idea of what affects option prices. So we have the actual stock price, and that we discussed in the delta. The delta affects the option price based off the stock price. The strike prices also affects the option price, expiration date, interest rate, dividends, and implied volatility. All this gets entered into a formula to give you the price of an option. So Vega, a change in volatility will affect both calls and puts the same way. An increase in implied volatility will increase the price of all options on an asset, and a decrease in volatility will cause options to decrease in value. So let's say we have option XYZ at $1.50. Vega is 0.25. Implied volatility is 20%. Implied volatility increases to 21%. That option is now $1.75, and vice versa. So strong news, strong earnings, these things are going to affect implied volatility. Also bad news, the opposite can happen. The further out that the option is, the higher the Vega will be. So this one is 40 days to expiration. The Vega is higher, and as they get closer, it's lower. Rho is the left out Greek. Reason for that, it's because it's sensitive to the interest rate. It's kind of like Vega, the way it moves, but this is more for long-term investors in options. So let's say the interest rate is 3%, and you have a $100 call option with a Rho of 0.45. If that interest rate goes up to 4%, that'll be a 45-cent increase. And also the same if that interest rate goes down. A lot of option buyers don't look at this because they don't hold it long enough for the interest rate, and the interest rate doesn't change that often as implied volatility. So now let's put this all together. Let's look at stock price XYZ. It's currently trading on the NASDAQ at $45 a share. I decide I want to buy options because 45 is too steep for me. So I find a strike price that I'm happy with, I find a date that I'm comfortable with, and I find a price of $2 per contract. Each contract represents 100 shares, so $2 times 100 is $200. So my options, the option that I chose, will cost me $200. My current delta is 0.35 cents. So at $45 for the stock, if it increases to 46, my option price will increase by 0.35 cents. On day 3, my gamma 0.06 will increase the delta by 0.06 every day thereafter. The theta time decay will decrease the stock price by 0.02 cents. We'll give it a Vega of 0.07, 1% increase of implied volatility. That's how much the stock price will increase. So day 2, our stock XYZ has jumped to $46, an increase of $1. So with the increase of that dollar, you see our option price is now at $235 because of the 0.35 delta, giving us a profit of $235, or a profit of $35 on our $200 initial investment. Theta time decay will subtract 0.02 cents, bringing us down to $233. Day 3, stock XYZ is now trading at $47. So now our delta is 0.41 cents because the gamma increased it by 0.06 cents. And we're going to apply the delta on the option price, bringing our option price to $2.74, which is $274, a $74 profit. But we can't forget about theta. Theta takes us down to $272 for a $72 profit. So now let's say news, catalyst, or whatever increased the implied volatility by 1%. That affects the Vega. Vega is 0.07 cents. So the option price will increase by 0.07 cents for the 1% increase in implied volatility, bringing us up to $2.79 for a profit of $79 on our initial $200 investment. Okay, so now let's take a look at how an option chain or purchasing an option looks on a real broker. So this is Webull, and we'll do AMD. On May 16th, I did a video on AMD. I was bullish on AMD. I talked about buying a leap option a year out. I went into the short term just to show the difference in implied volatility, the difference in price, the difference in delta, versus a longer term option. So this one was a short term. It was only a few months out. It was trading at $1, had implied volatility of 39%, open interest of 24,000, delta of 52, theta of 0.11. Then I went into the option that's a year out, the one that we were initially going to buy, January 21st, 2022. This is a leap option. It's a longer time out. I suggested buying the $75 strike price at $9 each. So now this one's more expensive, $900, but because of all the time. Theta is 0.0192, so it's not as high. Gamma Delta is about the same, 0.56. So for every dollar it increases. So this was a couple of months ago, trading at $9. That means $900. And these were the numbers. So the higher you get in the money, you see the higher the delta. That's kind of what I was showing. But this was my suggestion, buying two of these, 900 each. If we go in recent broker now, same time, let's AMD, January 21st. 2022, $75 strike price. That's trading at $20 now. You can now basically kind of like look at the any option though. You can see the potential profit. You know, you more than double your money on this leap option, because now it's trading at 92, and it was actually higher. I think it was a little higher than this. The initial, when we got into it, it was $77. But you can look at the stock now. You can look at the strike price. You can look at the bid, the ask, the last price that it was sold at, percentage change, implied volatility, open interest, and the delta. And you have the gamma here, and this will increase. This will be added to the delta. Theta, this will be the time decay. Vega, as the implied volatility increases, which is at 37%, this will increase your option price. And the rho, as long as the interest rate stays the same, this really won't change much, won't affect your option price. But you know, when you buy a leap option, a stock a year out, then more than likely you will get affected by the interest rate. I'm sure it'll change, but it doesn't fluctuate as much as implied volatility. You can buy a shorter term. Let's say you're just bullish for 3 months. This is going to get up to 97. So you buy the 92 strike price, 92.50 strike price. You see here, Vega's 0.17, Theta is 0.0386, Gamma is 0.0245. Delta is 0.52. That's just to give you an idea of how it looks. Thank you for joining me. That was just a brief introduction into the Greeks. Future videos are going to include like strategies around Greeks. There are people that take the Greeks and build their strategy around it. There are some investors that they only sell options. So they want time to be their friend. They make money because of the time decay. So there's a lot of strategies that we're going to get into, we're going to discuss. If you have any suggestions for videos, this was a video that was suggested to me. They just wanted a brief introduction to the Greeks, and this was my video for that. More videos coming up. We're going to have some due diligence videos on SMLR and a few other stocks that I'm looking at. We hope to see you on all our videos in the future. Thank you for joining. Don't forget to subscribe, comment, and hit the like. Thank you, and see you in the next video.